Cryptocurrency Investing for Beginners, the most profitable guide to invest in Bitcoin and cryptocurrency. Discover the strategies used by professional investors to find new opportunities every day. Written by John Patterson, narrated by Jim Rising. Chapter 1. How the Economy Works. Before diving deeper into the world of cryptocurrency, it is fundamental to have a good understanding of the global economy and standard currencies. In fact, the entire blockchain ecosystem has the mission to improve the current financial system. Therefore, it is clear how important it is to understand how it works before trying to improve it. Let's get started. The economy makes the world go round. It profoundly affects the daily life of each of us, so it is undoubtedly a topic that is worth understanding, even at a general level. Definitions of economy vary, but in general an economy can be described as an area where goods are produced, consumed, and traded. Usually, discussions focus on the national level, with research and studies referring to the U.S. economy, the Chinese economy, etc. However, we can also examine the economic activity through a global lens by considering the activities and businesses of all countries. What is the economy made of? Let's start on a small scale before making our way to the top. Every day we contribute to the economy by buying and selling. Other individuals, groups, governments, and businesses around the world do the same thing within 3 market sectors. The primary sector deals with the extraction of natural resources. This is where you find activities such as cutting trees, mining gold, and farming. The material obtained is then used in the second sector, responsible for manufacturing and production. Finally, the tertiary sector includes services from advertising to distribution. The 3-sector structure is the standard model used to represent the economy. However, some have expanded it to include a quaternary sector and a quinary sector, which further distinguishes the services included in the tertiary sector. Measuring economic activity. To determine the health of the economy, we need to be able to measure it in some way. The most popular way to do this is by looking at GDP, or Gross Domestic Product. This parameter tries to calculate the total value of goods and services produced in a country over a given period. Broadly speaking, a growth in GDP means an increase in production, income, and expenditure. Conversely, a decline in GDP indicates a decrease in production, income, and expenditure. There are 2 variants we can use: real and nominal GDP. Real GDP takes inflation into account, while nominal GDP does not. GDP is only an approximation, but it still has enormous importance in national and international analysis. It is used by everyone, from individual financial market operators to the International Monetary Fund, to obtain information on the economic well-being of various states. GDP is a reliable indicator of a country's economy. However, as in technical analysis, it is best to cross-check it with other data to get a more comprehensive understanding. Credit, debt, and interest rates. Lenders and borrowers. We mentioned that it all comes down to buying and selling, but it should be mentioned that lending and borrowing is also essential. Suppose you have a large amount of money available that you're not using. You may want to put it to work to get more money. One way to do this is to lend funds to someone who needs to buy something, such as machinery for a company. Even if they have no money available at the moment, once they bought the machinery, they can return it thanks to the sales provided by the machinery. In this scenario, you act as a lender. The other person acts as a borrower. To make it worth it, you decide to set a fee for the loan of your money. If you make a loan of $100,000, you might say something like, "You can have this money as long as you pay me 1% every month that it is not repaid." This additional cost is called interest. Based on this simple interest, the borrower will have to pay $1,000 each month until the money is repaid. If this happens, after 3 months, you would expect to receive $103,000 plus any additional compensation you specified. By offering this money, you create credit. We can define credit as an arrangement where the person receiving the loan is required to pay you back later. Credit card users will be familiar with this concept. When you make a card payment, the money is not immediately removed from your bank account. It doesn't even have to be there, as long as you settle the bill later.
Sample complete. Ready to continue?